In this presentation, I'm going to talk about financial risk management topic. The objective of this presentation is to know the financial risk, how financial risk arises, sources of financial risk, types of financial risk, tips of managing financial risk, and 5 steps of financial risk management process. What is risk? Risk is the possibility of an unexpected or negative outcome. Risk is the uncertainty of financial loss. Risk is anything that may affect the achievement of an organization's objective. What is financial risk? Financial risk arises from a company's ability to manage its debt and fulfill its financial obligations. Financial risk is when a company will not be able to meet its obligations to pay back its debt. This could mean that potential investors will lose the money invested in the company. The more that a company has, the higher the potential financial risk. Financial risk may arise in several ways, including instability and losses in the financial market, arising from movement in stock prices, currency, and interest rates. The difference between the business risk and financial risk is that business risk relates to the fundamental viability of a business. It refers to a firm's ability to profit and offset its operating expenses, including salaries, rent, production costs, and office expenses. On the other hand, financial risk is concerned with the costs of financing and the amount of debt the company incurred to finance its operations. How financial risk arises? Financial risk arises through countless transactions of a financial nature, including sales and purchases, investments, loans, and other various activities. It can occur as a result of legal transactions, new projects, mergers and acquisitions, and debt financing. The energy component of costs are through management, stakeholders, competitors, foreign governments, or whether when financial prices change dramatically. It can increase costs, reduce revenues, or otherwise adversely impact the profitability of an organization. Financial fluctuation may make it more difficult to plan and budget, price goods and services, and allocate capital sources of financial. Here are 3 primary sources of financial risk. Number 1 is financial risk arising from a firm's exposure to changes in the market prices, such as interest rates, exchange rates, and commodity prices. Number 2 is financial risk arising from the actions of and transactions with other organizations, such as vendors, customer, and counterparties in the derivatives transactions. Number 3, financial risk resulting from internal actions or failures of the organizations, particularly people, process, and system. Here are 8 common categories of financial risk. 1 is the market risk, credit risk, liquidity risk, operational risk, investment risk, compliance risk, reputational risk, and systemic risk. Market risk is the risk associated with the fluctuating price of an asset. For example, exchange rate. Market risk relates to incurring a loss due to market volatility, increased interest rates, or raw materials costs, and fluctuations in the foreign exchange rates. Credit risk is the risk of a lender losing money due to counterparty default. For instance, if I borrows money from the bank faces credit risk if I defaults. The bank loses money. In other words, there is a possibility that I will not pay the bank, and this possibility is what we call the credit risk. An economic crisis may occur if a nation's credit risk expands to unreasonable levels from a broader perspective. The worst financial crisis occurred partly due to a global credit risk expansion. Number 3 is liquidity risk. Key resources of this risk are potential cash flow problems because of the seasonal revenue shortfall, inability to cover capital assets to liquid assets, and efficiency market liquidity. Operational risk is a risk of financial losses caused by failures in internal process system or procedures. These failures are often caused by accidental human mistakes or intentional fraudulent activities. Every company should perform periodic security audits and adopt robust procedures and effective internal management to mitigate operational risk. Investment risks are the ones related to investing and trading activities. Investment risk is the probability or likelihood of occurrence of losses relative to the expected return on a particular investment. Generally, there is always a certain level of risk involved in all kinds of investment. Management of risk is essential to ensure a sound investment strategy. Compliance risk relates to losses that may arise when a company or institution fails to follow the laws and regulations for the respective jurisdiction. To avoid such risks, many companies adopt a specific procedures such as anti-money laundering and know your customer. If a service provider or company fails to comply, they may be shut down or face severe penalties. Many investment firms and banks face lawsuit and sanction due to compliance failures. For example, operating without a valid license. Reputational risk is also known as reputation risk, and it is the loss of social capital market share or financial capital arising from damage to an organization's reputation. So, criminal investigations into a company or its high-ranking executives' ethics violations, lack of sustainability policies, or issues related to the safety and security of either product, customer, or personnel can damage an entity's reputation. The last is systemic risk relates to the possibility of a specific event triggering an adverse effect in a particular market or industry. For example, the Lehman Brothers collapse in 2008 triggered a severe financial crisis in the US, affecting many other countries' systemic risk. This evidenced by the strong correlation between companies in the same industry. If the Lehman Brothers firm were not so deeply involved with the American financial system, its bankruptcy would be less impactful. An easy way to remember systemic risk is to imagine a domino effect where one piece falls first, causing other parts to fail notably. Systemic risk should not be confused with systematic or aggregate risk. The latter is harder to define and refers to a broader range of threats, not only financial. Systematic risk can be related to economic and socio-political factors such as inflation, interest rates, wars, natural disasters, and significant government policy changes. So, systematic risk refers to events that impact a country or society in multiple fields, This may include the industries of agriculture, construction, mining, manufacturing, finance, and more. Systemic risk can be mitigated by combining local related assets and portfolio diversification. Financial risk management identifies risks, analyzes them, and makes investment decisions based on either accepting or mitigating them. It is a process of understanding and managing the financial risk that your business might be facing either now or in the future. It is not about eliminating risk, since few companies can wrap themselves in cotton, or rather, it's about setting a limit. The idea is to understand what the company is willing to take, what risk should be avoided, and how to develop a strategy um, based on your risk appetite. The key to any financial risk management strategy is to plan of action. Managing financial risk is a high priority for businesses, regardless of their size or industry. An organization should consider various factors affecting financial risk. This can be classified into two categories: external and internal factors. External and internal factors should be considered when undertaking financial risk assessment. External factors refers to factors that are beyond the control of the company. Examples of external factors include economic downturns, market rates, industry changes, and law changes. On the other hand, internal factors refer to factors within the company's control. Example of internal factors include underperformance, poor cash flow management, bad investments, new competition, and staff issues. To take control of financial risk, an organization needs to identify and measure the company's risk, decide on the level of risk the company is willing to accept and retain, consider insurance to protect against business risk, identify potential issues with cash flow, review the company's financial arrangements with creditors, be cautious when providing credit facilities to customer, diversification the company's income resources, and last, regular assessments of the risk management process risk. There are 5 basic steps involved in managing financial risks. This is known as a financial risk management process. The risk management process is a framework for the actions that need to be taken. First step is to identify the risks that the business is exposed to in its operating environment. There are many different types of risk: legal risk, environmental risk, market risk, regulatory risk, and much more. It is essential to identify as many of these risk factors as possible. Second is, once the risk has been identified, it needs to be analyzed. The scope of the risk must be determined. It is also essential to understand the link between the risk and different factors within the organization. To determine the severity and seriousness of the risk, it is necessary to see how many businesses functions the risk affects. One of the most important basic steps is to map risk to different documents, policies, procedure, and business processes. The third step is evaluate the risk. A risk that may cause some inconvenience is rated lowly risk that can result in catastrophic loss is rated the highest because it is a crucial risk. It allows the organization to gain a holistic view of the risk exposure of the whole organization. The fourth step is treat the risk. Every risk needs to be eliminated or contained as much as possible. This is done by connecting with the field experts to whom the risk belongs in a manual environment. So the last step is monitor and review risk. Not all risks can be eliminated. Some risks are always present. Market and environmental risks are just two examples of risks that always need to be monitored. So under manual system, monitoring happens through diligent employees. These professionals must make sure that they keep a close watch on all risk factors. Under a digital environment, the risk management system monitors the entire risk framework of the organization. If any factor or risk changes, it is immediately visible to everyone's computer. Um, this system uses artificial intelligence to continuously analyze large volumes of real-time data, detecting patterns and anomalies that indicate emerging risks to organizations' digital assets and operations. Economic crises often result as failure in the financial risk management practices of major financial institutions. As the result, the field is constantly changing and evolving based on new rules and regulations that governs these financial institutions. The key to any financial risk management strategy is the plan of action. These are the practices, procedures, and policies the organization will use to ensure it does not take on the risk. The plan will make it clear to staff what they can and cannot do, what decision needs escalating, and who has overall responsibility for any risks that might arise. This can be quantitative or qualitative risk, and it is the job of a finance manager to use the available financial instrument to hedge a business against them.